All right, let's talk about something that sounds super complicated, but actually affects every single one of us: the nation's budget. You might hear it called fiscal policy, but we're about to break it down into something that makes total sense. You ever hear words like deficit, revenue, or expenditure on the news and your eyes just glaze over? Yeah. If you've ever felt like you need an economics degree just to follow along, trust me, you are not alone. But what if I told you it's way more intuitive than it seems?
That's the key right there. Because believe it or not, the way a government handles its money is a lot like how you and I handle our own finances. It really just boils down to what's coming in, what's going out, and how you plan for what's next.
So let's open up this giant wallet and see what's inside. What exactly is this master plan for a country's money?
Fiscal policy is basically the government's game plan for its money. It's the set of rules for how it collects taxes, how it spends that cash on everything from highways to salaries, and yeah, how it borrows when it comes up short. The whole point of all this? To keep the economy healthy and growing for all of us.
Okay, so first things first. Just like you need a paycheck to run your household, the government needs an income. So where does all this money actually come from?
The government basically has two main income streams. First, you've got direct tax. This one's pretty straightforward. It's your income tax, or a company's corporate tax. It comes straight out of a paycheck or a company's profits. You can't pass that buck. Then there's indirect tax, like GST. This one is baked into the price of stuff you buy. So while the shopkeeper sends the money to the government, they're collecting it from you, the customer. The burden gets shifted. All right, we've covered the money in part. Now for the fun part, money out. Where does it all go? Well, just like our own spending, it's pretty much split into two big buckets. And this is where that household budget idea really clicks into place. On one side, you have revenue expenditure. These are the country's day-to-day bills, the running costs. Think salaries for government workers, subsidies, interest payments on old loans. It's like paying your rent and your grocery bill. On the other side, you've got capital expenditure. This is the big-ticket, future building stuff. We're talking new roads, bridges, airports, things that are assets for the country. It's the difference between paying your monthly bills and, say, building an extension on your house. Now, let's get to the part that always grabs the headlines. What happens when the government, like any of us, ends up spending more money than it brings in? Yep, it's really as simple as that. When your total spending is more than your total income, you've got a shortfall. That gap, that's what we call a deficit. And it represents the amount of money the government has to go out and borrow to make up the difference. But here's the thing, not all deficits are created equal. First up, you have the revenue deficit. This is a big deal. It means the government is borrowing money just to pay its daily bills. The analogy here is perfect. It's like using your credit card to buy groceries because you're out of cash. It's generally not a great sign, right? It means you aren't even generating enough to cover routine expenses. Then you have the fiscal deficit. This is the big one, the number you hear about all the time in the news. It's the grand total of borrowing for the entire year to cover everything, both the daily bills and those long-term investments. Now, a high number can sound scary, but for a growing economy that's investing in its future, some amount of fiscal deficit is actually expected. And finally, if you really want to know how disciplined the government is being right now, you look at the primary deficit. What this does is it takes that big fiscal deficit number and subtracts the interest payments on old loans. So it tells you how much new borrowing is happening just for this year's spending. It's like a health check on current habits without the baggage of past decisions. So, you see, this whole thing isn't just about accounting. Fiscal policy is actually one of the government's most powerful tools for steering the entire economy. Think of the economy as a car, and the government is in the driver's seat. And there are basically two big moves. When the economy is sluggish, maybe in a recession, the government can hit the gas pedal. That's expansionary policy. They either spend more money on things like infrastructure, or they cut our taxes, which leaves more money in our pockets to spend. But if the economy's running too hot and prices are going crazy, that's inflation, they can tap the brakes, that's contractionary policy. They'll cut back on spending or maybe raise taxes to cool things down. It is a constant, delicate balancing act. So that brings us to the long game, right? How does a government make sure its finances are healthy for years to come without just piling up a mountain of debt for the next generation? Well, the strategy for that is something called fiscal consolidation. The easiest way to think about it is that it's the government's official get-out-of-debt plan. It's a conscious, strategic effort to bring down those deficits over time and manage the national debt so it doesn't get out of control.
And hey, this isn't just some textbook theory. It's happening in the real world. Just look at India. After the massive economic shock from the pandemic, the fiscal deficit shot up to 9.2% of the economy. But through a dedicated plan, through fiscal consolidation, they've been steadily chipping away at that number, bringing it down to 5.6%. This is what that long-term balancing act looks like in action.
And all of this really leaves us with the big central question of fiscal policy, doesn't it? Should a government act like a super cautious household, always saving and trying to avoid debt at all costs? Or should it be bold, invest heavily in the future, even if that means borrowing more today? There's no easy answer, and the path a country chooses really defines its economic future. What do you think the right balance is? Thanks for joining us.